Hey everyone! Today, we're going to unveil 3 stocks that I'm buying amidst the current market uncertainty. We'll delve into the tug-of-war between weakening consumer trends and upcoming Fed rate cuts, and how these factors influence our investment decisions. Make sure to stay until the end for a detailed list of stocks you don't want to miss. Alright, let's kick things off with a quick overview. The market is at a crossroads. On one side, there's excitement about potential Fed rate cuts. On the other, we're seeing weakening consumer trends, rising unemployment, and falling wage growth. This creates a confusing landscape for investors. Today, we'll break down these elements, discuss their implications, and reveal my cautious buy list. First, let's talk about the possibility of a 2024 recession. I've been saying for a while now that the economy is trending toward a recession. The evidence is there, but it's been a slow grind rather than a sudden drop. The post-COVID boom is fizzling out, and we're seeing a steady decline in economic growth. Back in March, I discussed the underlying trends of declining economic growth, weakening labor markets, and softening consumer spending. Fast forward to June, I highlighted the broad-based slowdown in consumer spending and the common mistake of imagining all consumers as the average consumer. In reality, American consumers need to be broken down into at least 2 groups, the affluent and those living paycheck to paycheck. Let's get into some recent data on consumer trends. It is expected that consumers will rein in their spending as we head through the second half of this year. Pandemic savings are depleted, lower-income households are maxed out on credit, and employment growth is cooling. Major companies like McDonald's, Starbucks, Visa, Whirlpool, and Diageo have all commented on weakening consumer spending. For instance, McDonald's noted that consumer sentiment remains low and that consumers are eating at home more often and seeking deals. Starbucks echoed this sentiment, pointing out the challenging consumer environment and the increase in volume at grocery stores. Visa mentioned a slight moderation in the lower-spend consumer segment. Whirlpool highlighted the downturn in consumer discretionary demand, and Diageo noted the challenging consumer environment in their recent earnings call. So, what does this mean for us as investors? Should we be excited about Fed rate cuts or nervous about weakening consumer trends? The answer isn't straightforward. While Fed rate cuts can be a boon for certain sectors, they might not be as beneficial for big tech companies. These companies have enjoyed strong performance partly due to the high Fed funds rate, which has allowed them to earn significant interest income on their massive cash holdings. Take Alphabet, for example. With the current Fed funds rate, Alphabet generates more net interest income than the net income earned by the majority of S&P 500 companies. This includes major corporations like Kroger, Target, and Starbucks. This boost from a high Fed funds rate is shared by several big tech names, including Nvidia, Apple, Microsoft, and Amazon. Now, let's talk about my buy list. If I believe a recession is likely coming, it makes sense to be cautious and consider raising some cash to anticipate better deals in the near future. Cash, as Warren Buffett puts it, is an option on everything. It allows us to generate some income while we wait for better buying opportunities. However, market timing isn't really my thing. I've tried and failed at it in the past, and the lesson I learned is that it's better to buy whatever is most attractive at the time, as long as it's not overvalued. So, here's what I'm looking at. First on the list is Vanguard Cash Reserve's Federal Money Market Fund. It offers a yield of about 5.3%. While this yield might decrease once the Fed starts cutting rates, it's a safe place to park some cash for now. Next, we have American Homes 4 Rent 6.25% Series H preferred stock. This offers a yield of 6.5%. I recently bought it at a price of $23.80, and it has some upside potential plus a solid annualized yield. Finally, Alexandria Real Estate Equities is another stock on my buy list. With a yield of 4.6%, this life science blue chip is currently undervalued. Before we get to the last stock, if you're finding this video helpful, please hit the like button and subscribe to our channel for more updates. Alright, the last stock on my list is Rexford Industrial. Offering a yield of 3.3%, this stock has high single-digit to low double-digit projected forward dividend growth. Rexford is highly defensive and recession-resistant, making it an attractive option in these uncertain times. So there you have it, folks. The market is in a state of flux, but that doesn't mean we should sit on the sidelines. By being cautious and selective, we can still find opportunities even in uncertain times. If you enjoyed this video, don't forget to like, subscribe, and hit the bell icon for more updates. And as always, happy investing!